Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. So today I have with me Shawn Muneio with BeQuest Funds. How are you doing today, Shawn?
Oh, doing great, Lance. Cannot complain, that's for sure.
That's good. Yeah. So Shawn, I think he's down in Florida, right, Shawn?
Down in Sarasota, Florida. Yeah, it's another beautiful day. Luckily, I get to look outside my window and look at the Sarasota Bay here. So it's a rough life here, looking at water all day long, but hard to stay focused on the work at hand in front of me.
That's right. But yeah, it's BeQuest Funds HQ. I think I saw on LinkedIn, you got a sign on the side of the building, right? So you're living the life, man. You're living the dream. It's good to see.
Martin and I were walking the other day, and somebody just removed their sign off the building because there wasn't any space. We're like, one call, all lined up. We finally got our space on the building, and it's good.
It is good. It's things like that, only an entrepreneur can appreciate. We did the same thing. We moved into this office, and we had the sign guy come out and put up the Verivest sign. So sort of a watershed moment, got a photo in front of it. And I know it's silly to some people, but it's you got to celebrate the little things in the life that is, of an entrepreneur. So Shawn,
we were here for 6 months, and it feels like we finally just moved in, right? When the sign goes out, it's kind of crazy.
Yeah, no, it's good. I call it the hang the shingle, right? Got to hang the shingle. Yeah, so Shawn is part of BeQuest Funds, and we actually had his business partner Martin on a few weeks ago. So excited to have the other half. I'm not sure. Better half.
Tell Martin.
I'll be sure to tell him. And they also, as mentioned, these guys are Verivest verified gold members. So we're excited to have them on board. And going from there. But today we're going to talk more on the sort of acquisition side of their business and just what that process looks like and purchasing notes and things like that. But before we get there, Shawn, why don't you share a little bit with us about how you got into the real estate business, what drew you to sort of note investing and really what led you to, we'll hear your side of the story on how you hooked up with Martin.
Yeah, thanks, Lance, and appreciate you letting us share a story here. But my story is a little different than most. I dabbled in real estate as a hobby forever. When I graduated from college, I went off into the IT world, IT sales specifically. Worked for some of the largest, Fortune 500 companies out there selling IT services across the U.S., sometimes across the globe. And so I began climbing the corporate ladder in sales, specifically very technical sales. And I always had a passion for real estate. It was kind of in my blood, right? My grandfather was a big builder. My father-in-law was a builder. And so when I got my first commission check, I'll never forget my first commission check as a sales guy selling technology, I went out and bought a duplex. and so that was I thought I'd made it, right? It was like a big deal. But that was my weekend gig forever. I was, cleaning up after people, fixing toilets, painting walls, but yet during the week I was flying around the country selling technology, and eventually got into financing large capital projects in the technology world. Worked my way up through corporate America. I'm like, this is the dream. I got a nice big salary, a nice safe 401k, and eventually my real estate passion, which continued, I kept buying Section 8 housing all throughout South Florida here. I knew that I didn't want to live in corporate America forever, and one day they were going to tell me that I wasn't young enough anymore, and I didn't have the skill set that I had before, and they would let me go, and my entire career would be, over in a letter saying that they didn't need me anymore. And so I knew that there was something else for me. And so about 5 years ago, as I was moving, they had asked me to move to the headquarters to take on some special big project for the company. I decided to sell my entire portfolio of Section 8 rental properties here in Florida, and because I was moving to corporate America, the headquarters there, and taking on some big fancy corner office job, and I sold all my real estate. And when I landed in Denver, I was looking for a place to put my capital. And like anybody, I knew it wasn't going to be real estate there because the market was really, really hot. And I decided to scour the internet for books on note investing. And so that's really what I want to do. I'm like, this is exactly what I do. I'm really good behind the desk, and I don't want to swing any hammers anymore or clean up after people. I want to buy notes. And so I found this great author who just launched a book on Amazon, and I downloaded his book. I was on a flight to Virginia one weekend with my wife, and I found this book on Amazon, downloaded it. By the time I'd finished the book, the plane was landing. And at the end of the book, there was an email address of the author, and so I'm walking off the plane. I'm emailing this author. I'm like, this is a phenomenal book. This is exactly what I'm looking for. I really want to get in this space, and so anything else you can feed me with, like, I'm all ears. Within 5 minutes, this author I've never met just read his book. He'd email me back with his contact information, and we became fast friends. I flew to DC to spend a few weeks with him. It turns out I spent the next 6 months with him. That author was Martin Sines, now my business partner. It didn't take long before we got into business together. I left corporate America, and we started to build our own note investing business. Now, eight employees strong, and big fancy office building, and a real operation. And so it just started with a dream, a phone call, a book that I read. Martin's, I think I was, I don't know, I might have been the first person to download and read the book, but it was, within a few days of him launching it. Timing was everything. Timing was perfect. And so that's how we got started. We got started in 2017 together, and been building a business ever since.
Yeah, that's a cool story. So where did you end up initially hearing about note investing? Like to sort of, liquidate the portfolio, and where had you, had other exposure to, like, hey, you can go and buy these notes? I mean, where did you hear about that?
Yeah, I think I was, I'd found some Bigger Pockets episode of, somebody on there talking about how to buy notes from the banks. And for me, that was so appealing because I was done swinging the hammer. I was done, chasing rent. I was done just cleaning up after people. Like, I didn't want to do that anymore. I'd done that for like 10 years. That was my weekend gig, right? And I'm like, I want to own the paper. I want to be the bank. Those big shiny buildings that they have that just seem to get bigger and bigger every year. Like, how do I be those guys? And when I found a book on it, I'm like, if I missed the boat, because I'm always the guy that missed the boat on everything, right? I'm like, too late, as everybody else got into the notes space, and I'm the last person to find out about it. And sure enough, I think I found the book at the right time. After I'd, heard somebody on some, Bigger Pockets talk about notes, and it was just amazing. The journey was crazy. I ended up buying my first note when I was in Denver, working out a payment term with the borrower, and I'm like, wow, this is crazy. I own the debt on this duplex across town, and I don't really care if the tenant leaves or the tenant, whatever, misses his mortgage or his rent payment. Like, it doesn't matter. Like, I'm still getting my payment. And so that's what I just fell in love with the business immediately. I'm like, I need to get out of the corporate America and I need to build a business around this. Because what I found was a lot of people, a lot of people use it as a hobby. It was like another hobby. I didn't need another hobby. I really wanted to turn it into a
Yeah,
real business.
no, I can I can relate. I mean, I think I was in the IT world too, and especially for me, it was the late '90s, and that's really, I mean, obviously, internet. I mean, it was just at a breakneck pace. The innovation and the changes, and unlike you went more the corporate, but I was more in the small to medium business and consulting with them, and I mean, it's just like the change is just so fast. Like everything was out of date before you could even learn about it. I mean, and that's sort of one of my superpowers is just learning fast. But it was like, holy smokes, keeping up in this industry is just everything is just constantly changing. And similar to you, I think I realized that although I was good at it and I consulted with clients and was able to help them implement and leverage technology, to run their businesses better. And, that I enjoyed that part of it, but realized like my passion isn't with IT. Like that's not the passion. The passion is about, business and I think for me too, just deciding to get out of it and selling out to my partner and much the same as just, I knew a guy, my business partner now, Matt Burke, same thing, and he was, doing lending and just realized that it's more abstract. It is a little harder to get your mind wrapped around, but in the long run, its ability to be a wealth builder and, I mean, it just has, so much, there's so many good things about it, right? Whereas, not having to worry about the tech passing you by and, now I have the opposite problem, right? Of course, it feels like I'm pulling the wagon uphill on this side because no one adopts anything quickly and it takes everything forever to change. And, it's kind of like guardrail to guardrail, but definitely can, much like you. And I was just like drinking from a fire hose and just like, oh my gosh, this stuff is amazing. These financial instruments and these private markets and all the different ways and strategies that you can leverage real estate of all shapes and sizes. And I get to do that every day. So I've got people calling me up every day, sharing some new strategy or way of making money in real estate that I had never even heard of. So it definitely is a lot of fun. So for you then, getting into it and going, okay, this is great. I can be the bank. And now as you guys have built up and really at scale, because I mean, there are, like you said, there's a lot of hobbyists. I mean, there's a lot of people who, buy a note here or there and, that's a whole thing and they put it in their IRA or whatever. But to really do it at scale is a different thing. Now, even doing it at scale a few years ago was much easier than it is today. I think that in the last 5 to 8 years, the regulatory environment for this particular strategy, just buying notes, is it's made it more difficult. Like most regulation does, it sort of freezes out the people that Anyway, we could go another episode on that, but maybe for you can kind of share a little bit about. It's one thing to buy 1 or 2 notes, but for you, especially in being in charge of acquisitions at BeQuest, how do you do it? Like who are the sellers and who are you reaching out to? And like, is it super consolidated now, or there's just not as many people that are selling stuff? And maybe just give us a little bit of insight into what that actually looks like. Cause it seems that there's a lot of effort that goes into, it's one thing to have some partnership that's got some, notes in it, right? And you can invest in it and get the income stream. I mean, that's great. But the process that you go through to even make that a reality is pretty onerous. So maybe just give us some insight into that.
Yeah, it is. It is. And, it takes a strategy. It takes time to implement these strategies too. And so, it wasn't long ago in 2017 that really I began to dig into this industry and start developing the relationships that I rely on today well over almost 4 years later. And so I can tell you that, we buy assets from people that are bigger than us, right? Because we're always, pulling down assets from the market. And so just developing those relationships just takes years, especially in the note business, because a lot of proprietary data passes back and forth between buyer and seller. And so people will only trade. They prefer to trade with people they've already traded with in the past. And so that's like everybody's default. Like, I'll trade with you again because we've done it before. I know what to expect from you. You know what to expect from me. And so those relationships just take years. And people now care about compliance. We just recently ran into an issue with a state whereby we were actually ahead of the curve. And we just found out recently that, the states are actually going after people who are trading assets in particular states with people who aren't licensed. And so, we actually see the regulatory environment as a positive for us. A lot of people see it as a negative, but we've embraced it. We've jumped in. We've done everything the states have asked us to do. We've spent the time. We actually have a dedicated resource on our team focused on compliance. We see it as a way, it's really a way to keep competition out of the space. And we've actually embraced it. And so, like you said, the investor who was years ago just buying a handful of assets and holding them, maybe even working out some non-performing notes, that's not a viable solution today. And so Martin and I knew that in order to stay in this business, we had to grow. We had to get big in order to be able to, pay for compliance and pay for extra legal advice and pay for, people to do audits on our assets to figure out, where we're in compliance, where we're out of compliance in certain states. And so we knew early on that we actually had to get big. And so we actually embraced the whole compliance and regulatory piece of the business, and we see it as a way to keep folks out. But the whole acquisition side of the house is complicated. But we buy from people that we've bought with over the years. As Martin and I, before we launched BeQuest Funds in 2017, Martin's been buying non-performing mortgages since 2012, but we came together in 2017 and started buying non-performing mortgages together in an entity that we managed. And so we did that for years. But what we realized was the reason we launched BeQuest Funds is because we didn't see non-performing mortgages as a long-term strategy in our business. We knew that eventually it would be really, really hard to source non-performing mortgages. And so we used to produce a product called Reperforming mortgages. That was our end goal. That was our product we produced. We'd take non-performing mortgages, get the terms modified, and we would produce reperforming mortgages, and we would sell it off into the marketplace and recapitalize. Like, that was the game. Over and over again. We'd buy a tranche of non-performing, our asset managers would work on them. We'd produce reperforming mortgages, we'd sell them off into the marketplace. And so we were really good at producing this gold called reperforming mortgages, refining it. What we realized was if we could build a fund that bought reperforming mortgages and would hold them long-term for cash flow, we knew that if and when the non-performing mortgage market dried up, we would have a business that would last, for 20 or 30 years to come. And so that's when we made the transition in late 2019, when the idea of BeQuest Funds came about, worked with our attorneys to generate the PPM. And sure enough, in March of 2020, one week before the pandemic, we launched the fund. Perfect timing. Our attorney said, it's Friday the 13th, March 13th. Do you guys really want to launch the fund on Friday the 13th? We're like, absolutely. Like, we've been waiting for this thing for 6 months. Like, let's launch the fund. And a week later, the country shut down. And the $1 million we already had committed in the fund, like, those people somehow vanished into their house. But anyways, we created BeQuest because we were experts in producing reperforming mortgages. And so, like, we're already experts in this space. Like, why don't we go to the market and acquire these assets? Why don't we acquire these assets from our competitors that used to compete with us in the non-performing space? Those guys are still out there producing reperforming mortgages. Let's just go buy their assets from them. And so that's what we did. We raised a bunch of capital, went to the market, all of our non-performing mortgage friends. We bought a lot of their reperforming mortgages, relationships we had from over the years. And then we tapped into some new sources because our purchases are much larger and we were able to go up market and buy.
So you're still able to, even though they're, I'm assuming you're still acquiring them at a discount to UPB, to the unpaid principal balance.
Yeah, absolutely. Because it's a reperforming mortgage, there's a scratch and dent theory in the mortgage that the payment history isn't perfect, right? And so the debt can't technically be securitized and it doesn't trade for par, right? And so we go to the marketplace because it has, a flaw in it per the banks. The terms have been modified. There's a track record that didn't look perfect. The pay history wasn't completely perfect. And so we love that kind of stuff. That's perfect for us. We used to buy the debt when it wasn't performing. Just imagine our team were like, "Oh, you're bringing it. It's already paying." They're like, "Yeah, it's already paying." We're like, perfect. So for us, it's good. I mean, we still we still have to have a high laser focus on making sure these assets perform. But we get a discount for that, right? We get a discount, and because of the discount, we have a laser focus on every single payment when it's due. Our team is on every loan, every day when borrower's one day late. We know these are high-touch loans, require a lot of attention, and our team is laser focused.
So is that really what it comes down to then? It's just that when you've got this loan, that, hey, if they don't make the payment on time or whatever, if you jump on top of it, and it seems to me that you guys are very service oriented. So it's not your, when they call up, it sounds like your people are sort of, they know how to disarm these borrowers where they don't feel like it's just some big corporation that's just going to, come down and turn the screws on them. Is that kind of part of it too? Then it's just that you guys kind of drill on how to disarm and build relationships with the borrower should they not start paying, or is that?
Yeah, absolutely. It is really all about building relationships with the borrowers, and this is real. Now we don't service our own debt, right? We don't service our own debt. We have licensed servicers who service the debt, and they're also making calls to our borrower. But when's the last time you actually heard from the company who owned your debt, not just serviced your debt? And so, we call our borrowers and we're like, hey, BeQuest funds, we own your mortgage. You realize, you're a few days behind. And they're like, well, who are you? We're like, well, we own the debt. They're like, oh, no, I send this payment to our servicer. Like, yeah, they service the debt. We're watching them too, but we actually own the debt. And so they're actually hearing from us too. When's the last time you actually got not a call from your mortgage company, but the actual company who owns the debt? And so probably never. And so they know who we are. They know we own the debt. They know we're not just servicing the debt. Our team builds relationships. I was just walking past one of our asset managers' office the other day, and he's sharing a spaghetti recipe with one of our borrowers, and so I'm like, that's exactly what we want. Right? We want them to know who we are, and like we're real people. We have families, like we care, and we're building relationships with people.
Yeah, and is there like some component too then of, once it obviously becomes seasoned and the dents aren't as obvious, or is that like part of your strategy then is to like maybe help them find an exit, like a refinance opportunity, or or for you guys, you're kind of like, hey, they keep paying, man. That's the whole thing. We've got this yield now on this loan, and if they want to carry it to maturity, then that's great. Or how do you guys look at that?
Yeah, honestly, we built this fund as an evergreen fund intentionally. We actually hope to collect every single payment on every single loan until all the loans are gone. That's the goal. We do get a capital gain as fund operators. We like that. When a loan pays off, obviously we bought it at a discount, but that yield will continue. And my asset management team my acquisition team, doesn't have to go back to work and deploy the capital if a borrower doesn't refinance our debt out. And so, it's a win-win. Honestly, we want to collect every single payment from every loan that we have through full amortization. Happy to do that. And the model works. If a borrower decides that our debt is too expensive and they need to refinance us out, well, it's a capital gain for the fund. The acquisition team has to go back to work to redeploy the capital. Both are good. We'd rather just collect the money for the next 20, 30 years. That's the plan. So we really don't push people in a direction. We're actually happy either way.
So what do you think just the natural organic runoff of that kind of portfolio is then? Like, it's like, if you take that stance, is it 10%? I mean, because the options are they refinance or they sell the home, right?
Yeah.
I mean, do you see much of that? And I suppose the servicer handles all the payoff demands. And I'm just curious, because I know like with our hard money portfolios, right, we probably had, and this was shorter term, I mean, 3, 4, 5 year terms. But I mean, you're running off, like, to your point, I mean, 40% of the portfolio a year. Right. I mean, that means that, you've got that capital. You gotta keep originating. In fact, that's one of the reasons why we got out of that, was that, of being originators and lenders exclusively ourselves, because of, it's just like, man, there's certain markets where it's just hard to originate new loans, and it's super competitive. And so anyway, like what kind of runoff do you guys see? Is it 10, 15, 20%?
So we buy mortgages on houses where it's their primary residence.
Yeah.
So it's a different maybe different asset class, but in most cases, some of these borrowers, homeowners, have been in their house for 20 years, and we actually bought the debt. So we actually less than 10% of the portfolio turns over annually, which makes it really nice for our team. And so we're not seeing a lot. I mean, we're seeing a little bit more now with the interest rates that have just come down, right? A lot of more people are refinancing our debt. It's not a ton. Like, it's definitely not 40%. It may have went from 10 to 12%, right? So it's not, and we see this just as a temporary, thing that's going on as, Fed comes in and kicks up the interest rate, slows down the economy a little bit. I think we'll see less of the debt being refinanced. But we're seeing less than between 10 and 12% of the portfolio turns over annually, which is a very it's a good ratio for us. We're actually happy with that. We don't really want to see more, and it doesn't require a ton of work on the acquisition side, and it's just really kind of that cash that does come in from refinance. It just helps because I've got a trade already on the way, and I was already deploying the money, and so the trade went from $1 million to 1.2. So I got some extra cash to deploy. So it doesn't really impact our business model. We're in the acquisition mode. We're raising a lot of capital, and so we're trading every few months a few $1 million worth of assets, and so it's a perfect flow for us. Yeah.
And then for you, I mean, on the acquisition side is the hard part figuring out, because you got a face rate on some note, whatever, 6-7% or whatever, and then it really comes down to you kind of have to underwrite the discount to get the appropriate yield, right, for you guys, because you do have sort of you've got a number, right? I mean, like your blended yield across the entire portfolio needs to be I mean, greater than 9 or 10 or 11, whatever. I mean, so is that the hardest part for you, is that you get these packages where, I mean, are you sort of like negotiating is it a discount to like on each separate loan, or do you actually like, it's sort of just this blanket, like, we'll pay you, you've got this package and I'll, it's face value is this and we'll pay you, this much, which equates to X discount. Like, how does that whole thing work?
Yeah, every loan runs through its own underwriting process, right? And so even though we buy in pools, we'll underwrite every loan. Everything goes through the same process. It takes us, 3 or 4 weeks to underwrite a big portfolio of mortgages we're buying. And so every loan has to go through the minimum cash on cash return requirement. And so it's all got to pass. And so, yes, we look at every single loan, and then after we've gone and looked through every single loan and provided a minimum cash on cash we need from that type of asset based on the credit score or the equity coverage, the state it's in, all of those things, it's fairly complicated, but every loan gets a price. Every loan has a cash on cash return calculated on it, and then we look at the whole blended pool and see if the seller wants more, then maybe we can lower the cash on this loan and this loan and this loan. And so it's, sellers, most sellers focus on the discount that they're selling it at. We focus on the cash on cash return on the portfolio. And so every loan has to go, it has to stand on its own. It may be that a seller wants to sell an entire portfolio, but only a portion of that car fits into a cash on cash return model that we can pay for it. And so I'm going back to the seller and be like, hey, I know you want to sell this whole thing, but I can only take this piece.
Yeah.
And most of the time they're fine with it. They're just trying to sell loans, and so we're a buyer.
Yeah, they're trying to move inventory. So, yeah, that makes sense. Yeah, I mean it really is. It's about, for you guys, that's the beauty of it, is having this diversified portfolio of assets, right? Diversified by borrower, and obviously, geography. I mean, these homes are all over the country, I suppose, right?
We're in 35 states across the U.S. The portfolio is up to about 180 loans, about $8 million in unpaid principal balance. So it's growing rapidly. Quarter after quarter, it grows substantially as we raise capital. And the average fair market value on these properties is around $300,000. So these aren't $100,000 properties in rough parts of the neighborhood. This is your traditional middle class home in the suburbs, across the U.S. And that's why we love this asset class.
Yeah, that's good stuff. So, where can people learn more about what you guys are doing? I know we had Martin share, but maybe for those who didn't catch that episode, I'd suggest you go back and sort of hear the other side of the story. And but where can they learn more about BeQuest funds?
Yeah, so you can find us on www.bqfunds.com. That's our main website. We talk about the fund and the different classes we have and the different returns on the website. But if you want to get on our mailing list, you can just email me directly at info at bqfunds.com, and you'll get on our mailing list. And every week we send out a letter to our people who are looking to invest in our fund, talk about what we're doing, different topics. We actually do some really cool videos every so often. And so if you just want to, hey, I'm not ready to invest, I just want to be connected with you guys, and we'll send you one email a week. We won't pepper you with a ton, but just email info at BQ Funds. We'll get you on our mailing list, and you can start researching us.
Cool. Sounds good. Well, I appreciate your time, Shawn. You have a great day, and we'll talk to you later.